Welcome everyone to this week's collective learning meeting, co-hosted with the System Dynamics Society's Economics Special Interest Group. Please remember to mute your microphones unless you want to ask a question. Feel free to ask questions at any time. And please also feel free to use the chat box. If you type your question there, Christine Tang, can ask the question for you. Our presenter today is Roberto Pasqualino, who is a research fellow for the Economics of Energy Innovation and System Transition, which is a University of Exeter-led project. And we'll be presenting part 2 of this presentation on the Economic Risk, Resources, and Environment, ERRE, or ERRE model.
Yeah, we can call it as you like. I normally call it ERRE. Okay. Thank you very much, Christine, for introduction. So let me start by sharing my screen. And here it is. And let's go full screen. I assume you can see the slide now. So thank you, Christine, to let me know. So first of all, thanks everybody to join this call today. My name is Roberto Pasqualino. I'm Italian by origin, working in Cambridge at Anglia Ruskin University in a project called Economics of Energy Innovation and System Transition. As the name says, we are dealing with all type of problems about energy transition. Today, the presentation I'm giving is about a system model that is one of the models that is part of this larger project. So the project is accounting for 16 simulation model of energy transition from basically actively engaged in doing policy analysis in China, India, Brazil, Italy, Europe, and UK. So we have a lot of models. My job is to really evaluate all of them in their technicalities. All the models are not just system dynamics models, but even agent-based or general equilibrium models or least cost type of models. So all different kind, and we try to basically demonstrate the strengths of energy transition of some particular models. And my model basically is supposed to help in that direction. The model we are talking about today is a model that I built over my PhD and postdoc at Anglia Ruskin University in Cambridge, UK. And it was built from the PhD thesis of Professor Sterman that itself was based on the system dynamics natural model of Professor Forrester, which basically was extremely interesting to me as a PhD student to actually start working with that particular model and also linking that together with Word3. And that's why we look at this particular topic today. The model focuses on risk, and that's why we talk about global systemic risk analysis with the ERRE model. The content of this presentation follows up on another presentation that I gave on the 5th of February last year, 2021. And in that presentation, I spoke a little bit about the structures of the model and a bit more about the economic theory of the model. So if you're interested in that talk is available on YouTube. Today, we talk mostly about the output of the model. So we first move from what are the research questions today that we can try to answer. And then we present what is the 6th chapter of the book, which is the simulation chapter. And we explain how the model had been calibrated. And we look at the sensitivity of short-term shocks in the model. And then we look at the long-term scenario analysis that is similar to the one of Word3 until 2100. And that's pretty much the entire analysis with this model. The previous talk, as I said, it was based on the economic theory of the model. The key element I tried to explain there is that since the system dynamics national modeling framework has always been kind of explained in terms of system dynamics concept, but I couldn't find in the literature a lot of work that was trying to catch the economic theory behind that model or where this model overlaps with the economic theory. That presentation explains where we lie, at least where these models, how actually end up changing that, lies in that economic theory. And I tried to explain that it is very important for a system dynamics modeler to understand that economic theory, because if not, it becomes complicated to transfer a clear message, in particular when talking to economics profession and talking to policymakers. So that can impact technically our results. But this time we speak about the model. I repeat a couple of slides from last presentation, just for those who didn't know about that. So the ERRE model is a globally aggregated system dynamics model that was developed as a tool to analyze systemic risks emerging from the interaction between economic growth and environmental limits, and potentially look at a little bit about systemic shocks. The analysis is kind of similar to the one of the World Tree model. Limits of growth is a very famous model. I'm sure most people know about that. The model was built up across two different projects. One was the Global Resource Observatory project, and one was the Center for Understanding of Sustainable Prosperity project. And that was taking a kind of a lifespan of from 2014 to 2019. So quite a long time between one thing and the other to build that up. The foundation of the model come from the two models. I already said that. One is the energy transition model of the PhD of Professor Sterman, and the other one is the limits to growth model from Dennis Meadows and the team of limits to growth. None of these two professors have ever really contributed to this work, just to make sure. It is basically just work of myself plus the team I'm mentioning here, so never had their contribution on this work. What came up from this is, the main thing is a book. The book was published in May 2020, and the model at the end of the work that was built in Vensim was made publicly available, and you can look at that particular link in these slides, where you can also find all the equations explained and all the behavioral tests I could find to demonstrate how the model actually works. So the model can be seen in terms of networks, if you like. So there are in total 9 sectors. At the top level of the network, you find climate, household, banks, public sector, and firms. But the firm sector can be broken down as a proper supply chain. So using the sort of dynamic of the beer model. And that supply chain is built up by a sector called goods and services, which basically supplies goods to the households. The agricultural sector, which also supplies food to the households. A manufacturing energy sector, which supply capital, so industrial capital and energy to each other, to all the possible models. So the entire economy is a closed loop system economy, where each sector produces everything that is demanded by the other sector, including themselves. The energy sector can be also broken down in terms of 3 sectors. That is fossil fuels, coal, gas, and oil put together as a big aggregate. So as again, kind of the global perspective of all these industries put together. Another one, which is renewables and nuclear, that we can call that renewables from this point in time, or green economy, let's say. And the biofuel sector, which basically is producing food that becomes energy. And that these 3 sectors compete among each other into the supply of energy to all the other sectors. An important element of this system is that I use financial stock and flows consistency as a requirement to monitor every single financial flow in the model. So the entire economy follows a double entry rule to monitor these flows, and at the end, having all the systems being stock and flow consistent, the entire economy become a stock and flows consistent economy, based on the principle of bounded rationality and bounded resource limits. And this is simply, let's say, a kind of a large model in the sense that you end up in about 3,000 to 4,000 equations in total, and each of those sectors can represent easily 600 elements. Some are more complete, more complicated, such as the firm sector in particular. Things like bank and government or climate tend to be simpler and smaller. So in this presentation, we tried to do two things, and they come directly from the book. One is to try to shock in the short term food and energy, and try to see the impact among each other, try to demonstrate if there is a relationship, which relationship there is between energy and foods at the economic level. And the second one is to look at the longer term and try to understand what are the possible global emerging risks coming from the connection between growth and the environmental limits. And these are two things that we look at in this presentation using this particular model. As I said, the presentation is quite technical. So we start with a proper model calibration, and going back to the model, you can look at that also in this perspective. You see the economy, so the supply chain really. Each of the sector includes a lot of variables, including prices, the labor market, interest rate, wages, debts. There's an energy market inside as well. There are world limits. On the right side, you find banks and public sector, and both of them have also, of course, debts and provide interest and loans and things like those. I want to bring your attention to the far left and far right of these slides, where you get exogenous elements that are those that, of course, are not explained within the boundaries of the model. And these are population, labor productivity as a core elements which determine the disequilibrium actually in this model. And then things like money creation that are created both from the side of the financial sector that can produce money, inject them in the economy, or through the government as a creation of new debts. So this slide tells what are the disequilibrium factors that impact the dynamic of the system. Of course, the system dynamics focuses on disequilibrium models. The question from the side of economics tend to be, why is the model in disequilibrium? Is the disequilibrium coming from endogenous structure of the system or from the exogenous elements? In this particular model, we have both endogenous and exogenous factors that determine the disequilibrium in the system, and then we'll show which one these are. Population is used as a demand basically of the model, and is basically using a curve which grows based on historical data and using the forecast from the United Nations, driving increasing demand and consumption in the model. Then we have the productivity. So each of the sectors produces based on these exogenous curves that we can define in a lot of different ways. We can assume exponential growth, or we can assume linear growth, or sort of things like those. For most models, for most sectors, the growth in productivity was defined as linear. And the reason why is because that compares to historical data where we have a decreasing growth rate of GDP in the years. And that's basically how that calibration ended up demonstrating the connection between the model and the historical data. So just to give a sense, when in this model, it is increased the labor productivity or even land productivity, what we get in the dynamic is that we increase the supply of each of the sectors, and this over time generates a decrease in prices, as a result, a decrease in inflation. Inflation is a very important variable. Because it generates, it's kind of the core of the entire system, where basically all the feedback loop goes into. The inflation can be reasoned in this model by mostly pushing the money back into the system. So on the one hand, if we generate money supply and we push that in the system, and we use that big, let's say, bubbles between 2000 and 2010, that somehow replicates into the limited structure of this model, what can be seen a little bit as what basically drove to the financial crisis or things like those, even though, of course, the model didn't represent those factors. So we couldn't do much more than that to try to replicate historical data. And the other one was applying government debt increase, and that was a deficit increase. That was, again, this kind of curve is the one that allows for the calibration to match the data. Again, rising money supply using government increase inflation in the model. And by playing within technology, population, and this money creation elements, inflation can be approached using the model. There are also two factors which are endogenous: disequilibrium in the system. I think these are very important. One is the propensity for saving ratio. This is basically a push. We apply a balancing loop which bring propensity a bit down in comparison to the equilibrium value, which should be 1, where 1 means that all the money that the household receive are basically spent. They don't save income. And what happens is, by decreasing the numbers, that they consume more. As a result, that increases again inflation. That has this sort of effect. And the second one comes from the firm sector. In particular, dividends has a similar effect of the propensity of saving for household. The income and profit of companies, if the dividend payout ratio is 1, get automatically thrown away as a basically back to the household, which can spend money. But if you decrease that number to less than 1, it means that they will keep some money for themselves in the cash, and they will use this money as investments for the economy. And that also will increase a bit of the money supply, and will start creating this sort of reinforcing loop which make the economy to grow in the system. So there are two balancing loops which control technically two reinforcing loops in the system. We go to the calibration, and that's pretty much what come up with the model. So step by step, the real GDP comes up pretty nicely out of this model. The inflation also is a bit more complicated. As I said, it's a very complex variable to model, and we explain that through these particular exogenous factors. Is also captured quite well. Government tax rate is endogenous in the system. Money goes in the government and go out in terms of expenditure mostly. As a result, that will generate a match with historical data, and the government debt also matches the historical in that particular way. When we look at fossil prices and we look at food prices, here we show kind of a strong limitation of the model, as I said. So if you look at the fossil price curve, we find that we can explain, for example, the first spike in the historical data and the big drop as caused by the financial crisis. Of course, our model is not made to catch the financial crisis, and that's why it will not. He's not even supposed to look for that type of spike. There is a second rise in the historical price, and the way we model that, at least the way we set the model to do that, is by applying business cycles into the energy sector. And the result of the basically supply of energy based on business cycle, as I said, that's the kind of beer game approach. There's a delay between capacity development and the demand that changes over time. It generates that sort of dynamic, which somehow is quite close to the historical price, despite, of course, being a global model that is not sufficient to say that's the right way of doing it. That's not the proper explanation, let's say, to explain prices. In fact, next work I've been doing was to look at that type of dynamic with a multi-country model and to go deeper into that type of understanding. The same is for food prices. Again, the model doesn't catch a financial crisis. That's pretty much the way we connect the dynamic of the system to the dynamic of historical prices until at least 2017 or 18. When we look at the temperature anomaly and energy production, basically the way we calibrate the system is to have the energy producing carbon and the carbon generating basically a temperature rise. We will see in a few slides how that is modeled in practice. And as you can see, we try to catch the trends. We don't, of course, look at the oscillation in the temperature anomaly. We go into the first part of the presentation, which is risk of shocks. So the first type of analysis we do is to run a shock in the shipments of energy prices and see what's happened to the food. Basically, that's the aim. What we find is that if we, of course, look variable by variable, when we apply a shock in fossil fuel shipments, we end up having a rise in price. That's actually quite normal for the type of dynamic in this model. For supply demand ratio, actually that's what generates that spike in prices. This scenario in particular uses three sensitivities for price dynamics, as a result generating three different curves. Real GDP is not very much affected in this particular scenario, and that's the reason why is because the shock is relatively small. The inflation also doesn't change much. The food prices that start changing, and the reason why is mostly driven by the biofuel production that, as you can see, start rising on the bottom right to exploit, let's say, the fact that price in energy start increasing. So there's more farmers that are interested in producing energy with foods, and that actually start generating an impact on food price as well. And then we end up having fossil fuel debts and fossil fuel interest rate, which are marginally affected. And the reason why is because when price of energy goes up, the fossil investor tend to actually build up more capacity. As a result, building more capacity builds up a bit more debt, since in this model, debt is anchored to the assets of one particular company. And the result of this is that the fossil fuel have actually a kind of an important impact on the food price system. If we do the opposite, we shock agriculture. Shocking agriculture means that we take away a fraction of the capital assets or the land assets of agriculture, thus impacting directly the production of the system. We end up, of course, that the default of land increases. That's the variable we shock. Agricultural land decreases over time, goes back to production due to the end of the shock. This impacts on decreasing inventory of food because we decrease production. The shipment also get impacted, of course. Lower inventory means lower shipments. Interest rate rises because of the shock that we apply, and the food price index rises as well. Of course, we have less food, we increase the prices. And as you can see, when we shock agriculture, we have little to no impact to fossil fuels. And this basically allowed to demonstrate that in that dynamic of historically shown as between food and energy prices, most likely it's energy that drives food rather than the other way around. So we move into the next phase of this presentation, which is looking at the core system dynamics limits to growth type approach to simulation modeling. And we look at the time horizon between 2000 2100 of the historical, so basically for food production and risk analysis. The way we apply that is that we look at basically the model as a tool to help us looking at potential future. So of course, the model is not made to predict any future. And in a similar way to limits to growth, we try to look at a series of scenarios, one building on top of the other, trying to demonstrate where are the limits of growth, limits of the environment, and how we can manage to fix them. So the scenarios start from a no limits scenario, where basically climate change doesn't even exist, resources are available as much as one required, to gradually including these sort of elements which determine the dynamics of depletion and dynamics of boundaries of the global economy. First, we start applying the climate system. we put that in the model, and we apply that to as a feedback, negative feedback to food loss, assuming a very mild effect from climate to food loss. Secondly, we increase that effect to have a much worse impact from climate to food loss. And after then, we start applying things like fossil fuel depletion. And basically, we start playing with the sensitivity of basically removing so basically assuming that resources can end some point and determines a sort of dynamic of collapse in the economy. After then, we try to apply these ecological limits. We stop there and we try to find solutions. And these solutions are the two basic ones, which are first a carbon tax, which is the scenario 5. The scenario 4 instead is a green economy growth. And the scenario 6 is basically the sum between green economic growth and carbon tax. As you can see, and this is very important, we use the model not try to just look at the whatever possible scenarios, but we gradually move from no limit scenario to a more risky scenario. So we are not really interested in looking at any possible future. We focus analysis on looking at the extreme scenarios. So from the first case, for example, of climate impact, we start taking the worst case, and we take a more extreme climate impact. From there, we take a more extreme extreme of climate impact, and we go for fossil fuel depletion, and then we move on that direction. So we start from the base run, and we simulate the climate type of problem. So in this particular model, we use a structure which is very, very simple for modeling climate systems. Of course, you can do much more complicated things. But we focus this on two reinforcing loops. And one is about what is called the hothouse effect in literature, which basically is trying to demonstrate that the more the temperature rises, the more difficult it will be for the wider ecosystem to absorb the emissions that we actually produce with the Anthropocene. And most important, we can generate even the dynamics that this wider ecosystem can start becoming an emitter to the atmosphere, just increasing even more the problem of climate change. On the other hand, we have the reinforcing loop that while we impact food loss with climate change, we will end up having a feedback loop which allows agriculture to increase production to still satisfy demand based on prices. And that will increase their production, and as a result, they increase also their carbon emission, just generating a second reinforcing loop. These are kind of risky things. The simulation we do for scenario 1 and scenario 2 are the first one that we step by step we start from assuming that there is no effect of climate to switching on all the possible table functions that you see here. So carbon sink, temperature anomaly effect on carbon sink, or temperature anomaly effect on food loss. And the second scenario is about assuming that the temperature anomaly effect on food loss, which is the curve you see on the right, increase the impact becoming worse. So starting from the first scenario, we have gradually increasing the effect of climate change on the system, impacting just food. That's a very important assumption. What we find out is that, at least based on the relationship included here, there is a little impact on real GDP and carbon emissions, mainly due to the fact that the effect on food is small, and at the same time, food is not the biggest part of the economy. Carbon atmosphere grows much together with temperature anomaly. As you can see, temperature is modeled as proportional to the carbon in the atmosphere, which is a very strong assumption. And based on the feedback loop that we applied, this temperature anomaly can go to very, very high level, even plus 80 degrees by 2100. This is, of course, an extreme, very extreme scenario that we hope will never happen. And secondly, we have the emissions from the wider ecosystem, which start rising, just basically releasing the stock of carbon in water ecosystems. And third, we have actual impact on food loss, and that will start impacting as well food prices. From there, if we go to the second scenarios and we look at the stronger effect of climate on foods, we find the following. The temperature normally doesn't change much. The reason why, again, agriculture is not the stronger factor determining that at the moment. The temperature normally becomes stronger, of course. The carbon emission start increasing more. That's because of the reinforcing loop we were talking about before between climate and agriculture. Secondly, we find that food planting start increasing the more the impact of climate on food loss. And the result of that is that we have a little bit of an impact on food production and food shipment, in the sense that because of food planting increases, the food production gets kind of mitigated despite decreases slightly. And this generates some sort of imbalance because food price increase even more due to the lack of food in comparison to the base scenario. And they start having a problem of demand satisfaction for food. That's basically what came out of this model. At this point, the idea is let's try to take the most extreme of those and trying to fix it. Okay. The first thing we do is to apply depletion. So depletion in this particular model is kind of simple in the sense that we have resources. This one follows the McKelvey diagram for resource extraction of economic and non-economic type of resources. So we have resources, that resources get discovered, they become proven reserves. Out of proven reserves, you can extract from the ground those reserves, and they become production, they become an inventory, they go in inventory, and then out of the inventory, they can be shipped all over the world and become energy for all of us to consume. The concept is that in this model, there is a limit to growth type of feedback loop, that the more resources decreases, the less they will not be available anymore to be discovered. As a result, this gradually collapses the system. So resources goes down, proven reserves will grow for a while, but then start decreasing, and then inventory as well will collapse. We apply in the shock basically 4 different levels of resources that can decrease over time, starting from the idea that they were unlimited. And at the same time, we assume that the green tank growth, so the labor productivity of green, keep constant exponential growth at 3%, which is like a kind of a positive scenario. So when we go into this scenario, we find the following. Of course, the energy is fundamental for making the economy to run. And without energy, everything cannot really work. We stop production automatically into the model when we avoid having energy. As you can see, that generates a terrible crisis when the resources are not sufficient to supply the entire economy for a certain time. Of course, we have the 3% growth of green tech, which basically allows still to have the plan B, and still these allowed to maintain growth over time. So despite in the worst case scenario, in this particular case, in 2060, we have a big collapse. At some point, the green tech will recover and allow for growth to carry on. It is interesting to see the dynamic of collapse in terms of GDP deflator, so the inflation type. So the inflation rises a lot during crisis and then collapse when the economy rises again, and then start increasing following the money supply, as we were saying before. The effect on depletion, of course, the less is the fossil fuels, the faster the collapse will occur. Same for inventory. As we said, we initialized the model to this sort of business cycle, which shows a lot of instability there. And while we look at the depletion scenario, that inventory can actually drop to nothing. And at the same time, the shipment drops to zero and faster as soon as we make it stronger, the less availability of fossil in the economy. The ERRE, which is the energy return on energy invested, which is basically how much energy I can extract out of the energy I consume, also collapses, of course. Started from about 60 barrel per barrel invested at the beginning of the simulation. That's pretty much the ratio, to something that is simply zero. And the renewable production, of course, takes over the market. It is important to show the worst case scenario, which is the continuous line in which renewable, yes, takes over the entire market, but it doesn't recover as much. And the reason why is that also renewable require energy to produce, partially. And this results that they even do not have sufficient enough of resources or even capital to produce enough as they were supposed to. So still scenario 3, we look at things like prices. So fossil prices rises into this crisis. So if we do not avoid the crisis, prices will go up and then collapse when stability will comes back. The market share of fossil, of course, worsen the less the resources are available. Renewable price will have an effect that is actually dependent on the fossil, so they follow pretty much the trend, but of course much more mitigated. Renewables takes over the entire economy. Fossil price is actually very important because biofuels during crisis become very important for farmers to produce energy rather than food. That's what they do in this particular model. As a result, that effect of fossil fuel crisis will generate a big rise in food prices. That's pretty much how the system works. And third, last of these slides, the temperature normally remain contained. So of course decrease a lot due to the fact that we cannot extract as much resources as we wanted. And the carbon emission, of course, decreases together with the collapse of the economy, which makes technically the economy still not to stay within the what we can call the climate target of +2 degrees. But that's also because of the fact that we calibrate the model to a very hothouse effect, which keep increasing temperature despite the maybe human activity doesn't occur anymore. So the next effect is start to looking at the solution. So we first start with green growth. This green growth is something that we try to test. As I said before, we had a 3% exponential growth of green growth for the previous simulation. Now we test between 1% and 9%. So we have 1% growth, 3% growth, 5, 7, and 9. Of course, 9% growth in green tech is a huge number, which brings, as you can see, the exponential to become 8,000 times more productive in 2100. This is again an extremely positive and unlikely scenario that can exist, but this shows as well how much effort is required or would be required by an economy of this kind to recover out of such a terrible hothouse effect. What comes up in this slide is that the economy in this particular case can even collapse, in particular when we have a 1% green growth, which is not enough at all to keep up with the energy crisis that we simulate in this model, can actually collapse the entire economy, which is actually not a good thing. Of course, when we start increasing the green tech growth above 5 or 7 or 9%, even generates a perfect green tech that can, of course, take over the entire economy very easily, with even generating a scenario which is not impacted by any crisis at all. This is also reflected into the GDP deflator, so inflation and interest rates. In the worst case, we have, as I said before, a rise in inflation and then a big collapse of the economy, which decreases also inflation over time. And the interest rate follows that sort of dynamic of inflation. So the interest rate is modeled such that takes as input inflation and try to balance out that effect to control it. So that simulates the sort of banking type of behavior to control that. Of course, these financial variables become very unstable due to the financial crisis. When we look at the fossil shipments, of course, the more the green growth improves, the better it is for the economy. The more fossil remain in the ground, we have more stranded assets. And the shipment more smoothly generates some sort of dynamic of collapse. Renewables take over the world. Biofuels also, in the big crisis, as I said, even worse, takes a lot of weight to produce energy out of food in the case of the crisis, or basically just remain a bit more under control without the crisis. And the ERRE again collapses, and the ERRE in renewables instead grows amazingly, such that it can cover the entire energy production in the world, which is amazing, even if it is, of course, impossible. So we move to the still scenario 4. We look again at the so we look a bit more variable in scenario 4, so green tech growth. One important element that I quite kind of like out of this model, which is very much in line with the thinking of Dennis Meadows and Jürgen Randers when they model limits of growth and the collapse of everything, is that in the case of global collapse, the energy fossil fuel economy tends to hire more and more people because the price goes up. They produce less, they have less capacity to produce, but they hire more people to get to that result. That's a very similar concept to what was said in limits of growth at the time. Renewables instead grows when productivity is low, and unemployment can stay down when productivity is very high, of course. The prices basically become exponentially rising due to the fact that no resource means more prices for fossil. The market share, of course, collapses at different rates. The price of renewables goes down when productivity goes up, which makes the economy stable and makes the renewable transition faster. Fossil price real again is impacted by this type of dynamics, and as I said, the biofuel market share can increase and collapse because of basically taking market in case of crisis, but then collapsing again because the green tech takes over the market. And in this particular case, we can manage to basically, in the case of best green tech growth, to decrease carbon emission and decrease the temperature anomaly even more, even though we are still at the plus 4 degrees at the end of 2100. We go into the carbon tax, and in this particular case, we test 2 carbon taxes, one in 2030 and one in 2020, so 10 years gap. And the carbon tax consists in a proportional tax that is 250% the size of the price of fossil fuels. That's in the simulation price of 2020, it is about $120 per tons of carbon into this particular model. Of course, that is dynamic and follows the dynamic of price. So it's a constant 250% increase on whatever fossil price we have. It is interesting to see the following thing, that when we apply the carbon in 2020, the economy is much better. We fix things. The fossil fuel is too expensive. Green tech grows faster, and this allows the economy to stay stable over time. So technically, a carbon tax in 2020 would help. In 2030, instead, doesn't help enough in the sense that there is still a crisis happening there. And we have kind of economic troubles. This is reflected both in outputs, in deflator, and in the revenue of the government. The tax revenue follows, as I said, a constant fraction of the price of energy. As a result, that varies together with the price. And the more the price is unstable, the more the revenue to the government is unstable, impacting both the energy tax revenue, the corporate tax rate, since every single income that comes from the government is decreased by the other sector as a decrease in tax. And the interest rate real becomes much more stable, of course, in the 2020 carbon tax. This is also reflected into a better or less good transition to renewables. And as you can see, the temperature anomaly results to be higher in the case in which the carbon tax is in 2020, which is the only caveat of applying the tax before rather than 2030. The reason why is that because of the crisis created in 2030, the economy, which is struggling to grow, manages to produce less energy, so less carbon, less energy and less carbon, and thus resulting in less temperature anomaly. Given those two scenarios, we decide to keep using the 2020 carbon as in a mix with the green tech growth to generate the last scenario. And as a result, we find the way to save the world. So green tech growth, so the GDP growth rate is more stable. The inflation is basically fine. We find much more stability in corporate tax and energy tax revenue. The fossil fuel shipment decreases faster with the increase of green tech growth. Stranded assets remain in the ground. The ROI of green tech is much better, is the same as the previous scenario, and the prices decreases drastically with the increasing green tech growth, and then we finally managed to keep the temperature anomaly at the +2 degrees, with basically almost null effect on food loss. So, of course, here we are heading to the end of this presentation. Of course, there is a lot of uncertainty in this analysis. So the relationship between the substitution of fossil for green or vice versa should be taken a bit more care about. We didn't model anything about minerals, so there is no really a constraints from the mineral resources that can stop the green tech to keep rising. The hothouse effect, we model something that is very strong. And the reason why is simply because we'd like to test the model to the most extreme case. More work to make sure the hothouse effect is calibrated properly is supposed to be done. We did a model thing like carbon capture, but at the same time, we didn't model the fact that climate change can have bad impacts, not just on food, but also on all the other sectors of the economy. And at the same time, the global nature of the model constrains the result that one can get out of the system. To summarize the entire presentation in one single slide, in the short term, it's likely that energy has more impact on food than vice versa. And that was proved by the first shocks. Climate change and hothouse effect, we have to say that they are irreversible risk to human activity. And despite we cannot really estimate how strong they might be, it might even be a system that automatically grows and increases its risk on human activity over time. Food risks. So the three type of sensitivities that we applied to food were taken from the IPCC report, actually, and they were assuming that the risk could be the average of tropical area, temperate area, or an average between the two. And as a result, we can tell that the tropical areas can have more impact on food than the temperate ones. Energy transition is, of course, a top priority, and we have to deal with that. And that's what we try to do also in this project that we're working on now. The speed of green growth is also critical. But at the same time, there are issues around how can we make sure that we have a good speed of growth. There is a problem of the energy market, which can definitely impact the food system via biofuels. And it is interesting to see that even carbon taxes applied at the wrong time can have negative consequences on human activity. And finally, in this particular system, only very unrealistic levels of green tech growth and carbon taxes really help to solve the problem of climate change, which makes me feel like that there isn't much that we can really do until to pretend that green tech growth can alone save the world. So I wouldn't say that's the only option. We have to take care of things like the social impact. We need to have social change above technology, trying to help us dealing with this sort of transition. And ultimately, would be important that the government is welcome to support the market transition, not just a market economy doing that work for us. And this was the last slide. So I stayed into 50 minutes, which is kind of a long time. And I hope you find this interesting. I know it's a lot of work and a lot of things to take, and I'm sure very happy to take any question you might have.
Yes, please feel free to unmute if you have any questions. There were a few comments in the chat. Some people unfortunately had to leave. And someone said that they're waiting for the policies to be implemented. Delays.
Perfect. Yeah. Let's wait for it.
I joined in a little bit late, but just so that this is already covered, are you posting the slides somewhere?
They are already online, so
okay.
They are in the link of this presentation.
Okay, thank you so much.
Is there any question? Shall I stop the sharing, or you want me to go back to some particular slides? I know it basically is still a lot of material, so probably it's quite complicated to follow that.
There was one thing.
Yeah.
Could you go a slide like to the conclusions?
These or that?
No, this, yeah, that one, the summary, yes. So I was just wondering, is there any way to account for the cumulative buildup, or are we not considering that when it comes to models? So like greenhouse gases or emissions, they kind of build up as the years keep going by, and nothing is done to, well, not nothing, but very little is being done to actually reduce them. So is there a way to account for that in the model that you've presented?
Well, so I think it is possible to do that. I mean, technically, it's quite simple to apply another sensitivity out of this model. So as I said before, the model is available online, so you can take it, download it, and if you want, you can play with it as much as you like. The answer to that, I think, is yes, it is possible to account for that. At the end of the day, it would probably remain within the limits of the sensitivities that we have looked at in this particular scenario. So when we end up doing this sort of analysis, I was looking at the most extreme cases that could actually become possibilities into this area. Of course, the fact that we put a hothouse effect, which is so strong and extreme in the beginning of the simulation, makes it very harder to save the world in different ways. But at the same time, this particular model allows to demonstrate that whatever simulation you want to add in the system will potentially work. And that element, yes, can be definitely added and most likely remain within the system sensitivities that we applied in this simulation.
I see. Thank you.
Thank you, Varun. Is there another one? Didn't see.
Yes.
Have you already proven the validity of your models by making some policies applied with success? The answer to this one is technically no. So as I said, the problem is that the global model makes you always in troubles when you try to define a policy properly, because it's a global model and there is even no point to try to fix a policy that will be listened by any government. So it makes much more sense to do that type of work with the national models. If we do that with a global model, again, since we cannot estimate properly, at least I can't estimate properly, things like hothouse effect or what is going to be the price of fossil fuel in 10 years or 15 years. This makes things much more complicated and a bit more speculative. Let's say if one wants to pretend to model a policy and apply that to demonstrate something makes sense or doesn't make sense. As I said, it is very important, and that's what we are finding out as well into the project economics of energy innovation, system transition, that is always a matter of involving a policymaker that makes a model to be effective. So it's not, you know, what was Sterman was saying this sentence that I always like: research shows that showing research to people doesn't work. You know, these kind of amazing sentences, and that's exactly the case actually. So we have to have a policymaker or somebody that believes in your work and is there and contracting you to actually do the work with them. Of course, with a global model, this thing is not really possible, I believe, unless you go to the national scale at least. So my suggestion is, if you have a model like this, you want to be effective, try to build that for the national scale and then disaggregate that further. Yeah, so I hope that helps. Models with an horizon of 80 years are condemned to be never verified. Yeah, actually, I think that's kind of the case. So, of course, we're not planning to have a verification of the model. We are simply telling the story that we want to avoid something to happen. And so ideally, each of those scenarios is something that we would like to avoid to happen. We're trying to say that if some terrible risk happen in 2020, if the hothouse effect is already evolving at this point in time and is already a reinforcing loop, which is creating more and more energy, more and more carbon in the economy, and creating more temperature rise, then it's going to be very, very hard to solve the problem. And it's not verification we are looking for, is more like awareness, rising awareness of the risk that can come up, and try to find ways to deal with them. Of course, global models again have this terrible problem. Better work could be done by disaggregating systems, and that's actually what I've been doing into the EAST project as well. So I will be happy to give more presentation on that in the future. Any other question? Happy to stay here another few minutes. I think we have some more time, don't we?
We're 2 minutes past the hour, but I have time, and if people want to stay, please feel free. There were some questions above those. I don't know if I think you prefer to read, so you can filter however you like.
Yeah, I see. I guess, I mean, the material presented this way makes it also a bit complicated to catch the right thing. So I hope people will manage to look at this online on YouTube later. Any question you want to ask, please let me know. My link, my email, I think are available in the link. Anyway, roberto.pasqualino@aru.ac.uk. You just look for me on my website. You find me straight away. I'm very happy to answer any question you might have. Okay, that's the one. Thank you, Christine. Okay, so probably this is the time to close the talk for today. I hope people enjoyed and really happy to support further in the future if there is a chance.
Thank you so much for presenting, and thank you to those who attended.
Yeah, fantastic. So guys, thank you, Nick. Thank you, everybody. And really hope people found this interesting thing to work on. Really, any